talk about the current yield levels in fixed income and the opportunity that may create?
Yes, it certainly has been an extraordinary period of weakness for the bond market, with the most rapid rise in yields that we've seen in decades. US Treasuries have retraced almost all the way back to their previous peak in 2018. And of course, credit spreads have widened along with equities, so it has been very challenging for the aggregate. But the other side of the coin is that now that yields are at these higher levels, bonds represent just a much more interesting investment opportunity. In our analysis in the past, we found that historically starting bond yields are a really good long-run predictor of returns for fixed income. And so the higher yields that we see today are getting really quite attractive, both in absolute terms and then also even compared to equity earnings yields in other asset classes. Plus, if the economy does slip into recession, these starting yields give bonds a lot more room to rally. So now may be a good time to add selectively.
Aaron, speaking of diversification, the traditional balanced portfolios come under immense pressure thus far in 2022 as stocks and bonds have sold off simultaneously. Is the 60-40 portfolio dead?
No, the 60/40 portfolio is not dead. I think measured over a short time horizon, we've certainly seen higher inflation negatively impact both stock and bond returns, and certainly we've seen that year to date. But for portfolio construction purposes, it's really important to view this over a much longer time horizon. And we don't think that the correlation and diversification benefits of stocks and bonds has meaningfully shifted over the secular horizon. As you move later cycle, it can be really tricky timing that inflection point and when you tip over into a recession. So while bonds often underperform during late cycle periods like we've seen year to date, they tend to shine very early in the stages of a recession. And in fact, if you look at bonds and the performance over the last 7 out of the last 8 recessions, you've seen that bonds have actually had positive performance in the first half of those recessionary periods. Given the uncertainty that clouds the outlook, coupled with the more attractive valuations for fixed income, we do not think that now is the time to abandon fixed income. Portfolio construction is going to be key, and we think it's prudent for investors to expand the number of diversifiers in their portfolios, especially in an environment where the upside risks to inflation have increased.